Financial spread betting. Spread betting was once the domain of institutional investors, city traders and high rollers. Not anymore. You would now be hard pressed to find any other form of trading that allows such a scale of return. The aim of this book is to give you a basic understanding of how spread betting works so that, with a little time and effort, you can find out how to turn a pauper's budget into a king's ransom. However, an issue that should always be at the forefront of a novice spread bettor's mind is managing risk. As such, the secondary aim of this book is to explain the risks involved and how to reduce them. The book is accessible to investors with a basic grasp of investing and yet also interesting enough for more experienced trader. The book starts with basic what, when, why, where, who, and then progresses to the how in detail. The road to successful spread betting starts with education. By the time you finish reading this book, you should know how to place a spread bet, the rules of the game, and how to trade successfully. The appendices and glossary at the back serve as your quick and handy cheat notes when you start trading. As the saying goes, don't just learn the tricks of the trade, learn the trade. Biography. Michelle Baltazar is an award-winning finance journalist. She wrote a weekly column on derivatives for London-based investment magazine Shares. Prior to Shares, she worked for Australian business magazine Business Review Weekly. Introduction. During the summer of 2003, two close friends from southeast London, Clive Smith, an owner of a travel agency, and Joan Irving, a schoolteacher, made a decision that would soon change their lives. They placed a bet of £1,000 on a handful of shares through a form of trading called spread betting. The pair traded a host of shares including online company MyTravel, airline giant British Airways and pharmaceuticals group Sky Pharma. 8 weeks later, that 1,000 turned to winnings of more than £1 million. You would be hard-pressed to find any other form of trading that allows such a scale of return possible for the average punter. Spread betting was once the domain of institutional investors, city traders and high rollers. Not anymore. Clive Smith and Joan Irving are just two of more than 100,000 people across the country that have turned to it as a natural extension to their investment strategies. During between turning £1,000 to £1 million, there were periods where the bet could have gone either way. To make the chain of decisions they had made involved more than luck and sheer guts. They did their research, attended shareholder meetings and kept abreast with market news. The aim of this book is to give you a basic understanding of how spread betting works so that, just like Smith and Irving, you can find out how to turn a pauper's budget into a king's ransom. It is worth noting that before they made their millions, Smith and Irving made some costly mistakes. This brings us to an issue that should be at the forefront of a novice spread bettor's mind: managing risk. The secondary aim of this book is to explain what are the risks involved and how to reduce them. The road to successful spread betting starts with education. By the time you finish reading this book, you should know how to place a spread bet, the rules of the game and how to trade successfully. The appendices learn the trade. Why spread bet? Progress always involves risk. You can't steal second base and keep your foot on first. A quote by Frederick Wilcox, an author. What is spread betting? Let's start with a question. If you have £1,000 of spare savings and you want to invest in the stock market, what is the best way to do it? If you have the time and inclination to research companies, You could buy shares directly in a handful of companies and manage your investments yourself. If you don't have confidence in your own stock picking abilities, you could buy units in a unit trust or other collective fund. And a fund manager would then make decisions about which companies your money is invested in and take a fee for his service. If you don't fancy paying the costs for professional advice, you could put your £1,000 into an index or tracker fund. This would diversify your investment across a wide range of companies and ensure that you get the same return as the market average. No better, no worse. All these options are valid. None are inherently better than the others. Their suitability depends on your personal circumstances. However, there is another option which will, potentially, allow you to make much higher returns from your £1,000. It is called spread betting. Spread betting is a form of trading in which you bet on the price of movement of a share, index, currency, commodity, or bond. It is a way of playing the stock markets without actually owning any shares. The concept was created during the 1970s by a then 35-year-old investment banker called Stuart Wheeler, but it is only since the late 1990s that spread betting has gained widespread appeal. In a nutshell, it allows access to markets that were previously restricted to institutions, banks, and wealthy investors. How? The three main catalysts are the internet, the prolonged bear market of 2000 to 2002, and a simplicity of spread betting. A bear market is a market where there is not much activity, like a bear sleeps during when he hibernates, he sleeps. A bull, a raging bull, when it's a good, when the market is good. It's good to, in a society, it's good to have a bullish time. The internet jumped The internet jump started enormous changes to the workings of the stock market. First, it allows easy access to market information that traditionally was only available to institutions and wealthy investors. Second, it allows investors to try their hands at investing anonymously. Third, online trading systems have lowered charges to a level that is practical for both the average investor and the spread betting company. The bear market of 2000-2002 spread betting is ideal because unlike conventional share dealing, it allows investors to bet on the prices going down. The falling markets provided plenty of these so-called short selling opportunities. Simplicity. Spread betting is a type of derivative, a financial instrument that is derived from an underlying market, such as equities. Of all the derivatives available, it is seen as the easiest to understand. During 2003, while volumes in traditional share dealing fell by 30%, volumes in spread betting rose by 25%. In the same year, the total value of contracts traded was more than 20 million per day. From one product, the gold price, during the 1970s, there are now more than 4,000 financial and non-financial instruments to choose from. Financial instruments include equities, commodities, and indices, while non-financial ones include sports and fancy bets. In short, the industry is continually changing shape to reach a wider market.